Welcome to Finance Made Easy. When most people think of financial markets, names like banks, investment banks, and Wall Street usually come to mind. But what you might not know is that behind these shiny names, they're actually all middlemen, not fundamentally different from the study abroad agents or rental agents we encounter in our daily lives. They're all second-hand sellers of information. Why are financial markets filled with intermediary institutions? That's the topic we'll explore today: information asymmetry. Information asymmetry is the core feature of financial markets, and financial intermediaries exist to eliminate this asymmetry. What is information asymmetry? It is when one party in a transaction doesn't have enough information about the other party. This can lead to transaction failure or market failure. Financial intermediaries play a crucial role in reducing information asymmetry, and in our daily lives, we encounter many such examples. For studying abroad, you'd consult a study abroad agent. For renting a house, you'd consult a rental agent. For job hunting or recruiting, you'd turn to a headhunting agency. And when looking for a partner, you might even use a marriage agency. The financial market, by nature, has information asymmetry. This is because finance deals with credit transactions. In other words, financial markets trade things that are intangible and hard to touch or see. For instance, when you buy a house from bank, you can inspect the location, check if it's in a good school district, assess the quality of the house, etc. You can see, feel, and measure it. But if you were buying bank stock, what exactly are you purchasing? You're buying into bank's future prospects, its future cash flow, a concept that even as a bank shareholder, you might struggle to define clearly. Unless you can make accurate judgments about the real estate market, bank's internal management, its sales, and even its land reserves, the stock's value remains ambiguous. We often hear that finance is a virtual economy, which simply means that financial markets are fundamentally different from other commodity markets. There are no middlemen for apples or pears, but in the financial market, since transactions involve the future, the intangible, and the uncertain, there is naturally information asymmetry. This is why a variety of financial intermediaries have emerged to tackle this issue. Typical examples include credit rating agencies, accounting firms, auditing firms, and law firms. They all help reduce information asymmetry in various aspects, enabling smoother operations in the market. Of course, the most commonly known financial intermediaries are brokerage firms and banks. A brokerage firm, which we call a securities company in China and an investment bank abroad, plays a crucial role in reducing information asymmetry in the direct financing market. Let me start with investment banks. Many people may have heard of the Rothschild family from Currency Wars. The Rothschild family is a famous ancient investment bank in Europe, known for facilitating many financing transactions and reducing information asymmetry in the financial markets. A well-known example is when China's Geely acquired Volvo, a European company. Rothschild played a key role in facilitating this deal. Geely was a grassroots company from China, while Volvo had a long history and strong unions, and the acquisition regulations were quite different from China's. The Rothschild family has close ties with many European businesses, so during this process, they helped Geely communicate with Volvo suppliers, unions, and employees to reduce mistrust in the deal. In addition, the Rothschild team helped Geely navigate local government relations, negotiate intellectual property terms, and even arrange local financing for them. Many people say that without Rothschild's mediation, the acquisition would have been impossible. This illustrates the immense role that investment banks or brokerages play in reducing information asymmetry and facilitating financial market transactions. Now, let's talk about banks, which we interact with the most. How do banks reduce information asymmetry in the market? Banks collect deposits from individuals and lend them out, profiting from the difference between the interest rates. They need to ensure that these loans are repaid in order to make a profit. If everyone defaults, the bank would quickly go bankrupt. Therefore, banks conduct thorough assessments of borrowers' qualifications and creditworthiness to ensure repayment. This creates an incentive for banks to evaluate borrowers accurately. The more precise the evaluation, and the more information they provide about borrowers, the safer depositors feel, and they may even accept lower interest rates for their deposits. In other words, the more accurate the bank's information, the more it earns. On one hand, this enables banks to access lower-cost funds. On the other, they can identify who can bear higher loan rates and who has a higher risk of default, ensuring higher returns for themselves. Through the collection, analysis, and evaluation of information, banks reduce information asymmetry in the market and create a positive feedback loop, reducing overall market asymmetry. This is why banks are so vital in our financial system. From the very beginning, they have played a key role in reducing market information asymmetry, ensuring the smooth functioning of financial markets. No matter how we look at it, without financial intermediaries, the financial market wouldn't function. In a market inherently full of information asymmetry, high levels of intermediation are inevitable. Next week, we will begin our deep dive into the financial intermediary institutions section. In this segment, I will explain the characteristics, operational rules, and institutional arrangements of the most important financial intermediaries: banks, investment banks, and funds. Once you understand the operations of these intermediaries, your understanding of the entire financial market will improve significantly. This is Finance Made Easy, helping you gain a higher perspective and re-understand wealth.